Okay, good morning, everybody. Thanks for joining the third Swiss Value Day here. Basically, I'm going to share with you also our experience. It's going to be from a different perspective than the one of BWM. Basically, I'm going to share what we learned with the crisis in 2008, the big global financial crisis, and I'm going to try to do some parallelism with Warren Buffett and Charlie Munger, that I think, we all have read them, but personally, I have learned it in the hard way by losing money and messing it up. I'm going to cut my presentation to 15 minutes, and then I will introduce Grifols, because we presented them last year, and they had been under an attack from a short seller, and I think it's a very good opportunity to listen to them and also listen a little to us on how we deal with these issues. So I divided the presentation in three parts. Basically, value, the Charlie Munger way. So we finally understood it. Let me start with something that probably everybody knows. Buffett started, value investing in the 40s. He was really young. It's surprising, under 20 years old. And he started, as you know, picking cigar butts and just picking things very, very cheap with not a lot of analysis, just going through the pink sheets and choosing very, very cheap stocks on cash, on working capital, on equity. So traditional value, I would say. He was following his professor, Benjamin Graham, so probably all of us have read these two books. And this guy probably is, in my humble opinion, the pioneer of value investing. And just one thing, if this guy was the number one in value investing, and then you learn that his priority was really art and women, you're a bit surprised of what kind of personality he had. So then came Charlie Munger. He brought a kind of a new path within value, which I can sum up in investing good businesses. So they met in a dinner in the Omaha Club of Golf, I think in the 50s. I looked for the date, but I couldn't find it. And then they start talking 2 hours a week. So really, they fit. And these guys, over 75 years, they've been, the best story from the value investing perspective of the world. So this is our long-term investment fund classic, started in 2002, pure value, so more aligned with young Buffett, picking very cheap stocks. We move up a lot because the right moment was 2002. After the tech bubble, the valuations were cheap, value was very cheap, and it was the best fund in the world, one of the top funds. We went from 5 million assets to 2 billion. And then the crisis came in 2008, 2009, as we all know, and we really messed up. So the first 6-7 years, we did 30 points of alpha per year, and then we fell very hard in the global crisis. We didn't really lose money. So you see, we went up a lot, and then came back to square one. What did we learn? So this is our learnings. Maybe some value investors do not share the full thing here, but it's our opinion. When you go to traditional value or deep value, you tend to end up with cyclical businesses, lower quality businesses, sometimes problematic. Compounding is more difficult when you go to this deep value or traditional value or just picking cheap stocks. It is also more volatile because it's quite related to the cycle, in our opinion. So we understood that we should add a layer of quality. We learned it after, but this is what Charlie Munger was saying in his statements and through the newsletters of Warren Buffett. You could learn it, but it's much, when you see it happening, it becomes evident. So this is why we changed and we developed what we call strategic value. So this is our philosophy of investing. So what did we do? What did we learn? We developed a complete new theory after 2009, 2010. Then we had the European crisis, so it took some time. And this is basically the summary. We invest in what we call the 4Gs: good business, good management, good balance sheet, a good price. C&Ds, concentration and diversification. So we are very concentrated also. I think here everybody is quite concentrated, but we try to look for a lot of diversification within concentration. I will try to explain. RAS, risk-adjusted strategy. We put in different boxes the risk of every company. So we have 4 risk categories, 1, 2, 3, 4. Category 1 would be a basket of Nestlé's, and then we increase the risk. I will explain later. We also look for ESG category, and we qualify them, and we find a huge relation or correlation between good management and good ESG standards. So basically, the analysis is not numeric, how many CO2 tons you issue, how tons you issue. It's more a qualitative and numeric analysis. And we developed the watch list as a circle of competence. If we see a new sector, a new stock coming around us that we like, it doesn't go to the fund. It goes to the watch list. And then we stay there cooking and understanding it for the time we need. This is a slide that I like to put in every quarterly result. It's basically half of the portfolio of the classic. You can see very easy that it is very concentrated, 40% in 10 names. And you have many, many sectors. ISS is cleaning, Grifols is plasma protein, Pandora is jewelry, Leroy Seafood, Salmar are salmon companies, Medtronic is medtech, Unilever, you know it, Reckitt, Beckinsale, HPC, Mowi is another salmon company, Raytheon is aerospace and defense. So, you see half of the book is really in many, many sectors, in many, many countries. Most of the companies are international. So what we call the 4Gs normally are applicable to all of them. We make exceptions, like in Grifols, very concentrated and diversified. And this is the RAS strategy, risk-adjusted, what we call it. We define 4 risk categories, and we start with that. So the category 1 would be a basket of McDonald's, Nestlé, Coca-Colas, etc. that normally we buy at a PE of 15 to 20 times. We wait whenever they have a couple of quarters bad, and then we buy them because we think that the franchise is so strong that the business will be back in 2 to 3 years normally. Category 2, very solid companies, non-cyclical, but not at the level of McDonald's or Coca-Cola. So here we put Compass. We are also invested in Compass and MTU Aero Engines, which is an aerospace company. Category 3 would be solid companies, good companies that generate value over the cycle, but that are cyclical, like a cement company or a bank. And then category 4 is high risk. So as a starting point, we build 50% in 1 and 2s and 50% and 3 and 4s. And then we can move when the market is very expensive. It's counterintuitive. If the market is very expensive, you buy the 1 and 2s. And if the market is very cheap, you buy the 3s and 4s because they have fallen much more. So with that, we can balance a little bit. We are kind of crazy on numbers, so we have DCF and IRR per stock. Risk categories, ESG categories. So we have, for the pool, we have almost a P&L and a balance sheet for the fund. We can tell you what is the expected IRR of the fund. And it behaves very consistently because you have so many assumptions in the portfolio. Maybe you have sales and growth and margins and capex per company on the different divisions. So adding everything, it is very, very consistent. You make a mistake in one company, but in the other one, you make a success. So basically, we find it that over the years, the trading range is 12 to 17%, and the average is 14% return. And the watch list, I'm not going to go here in the detail, but basically we choose the sectors we want to be in, and we choose the companies we want to have in the watch list. We know them well, and then once they enter in a buying territory, we buy them. We don't follow momentum. And this is normally the picture of the book that we can give you. Also, the PE at December, this is December, price earnings 25. Let's go to 25 because we are in June, is 11 there, a bit more now. Price to versus the market at 15, dividend yield a bit higher, price to book 1.7. So we normally buy at a discount, so normally we trade at a 30, more or less 30% discount. And as a conclusion, I wanted to put some similarities with Warren and Charlie and challenge you to see who's saying what sentence. So strategic value, the 4 Gs. And the quote is, investing is where you find a few great companies and then you sit on your ass. So is that Warren or is that Charlie? So it's probably Charlie, I don't know, because I did that like a month ago. The second is fundamental analysis, right? We do analysis, we understand the companies, we try to understand the sectors, and basically the quote from this couple is, the 3 most important words in investing are margin of safety, which requires evaluation, which requires numbers, and this is important to have numbers in our view. Responsible investing, so this is easy, this was Warren. It takes 20 years to build a reputation, 1 minute to ruin it, and this is very important to us. We try to be very, very transparent. Long-term view, you can read the quote. This is basically Charlie, I would say also. And circle of competence, don't try, if you play tennis, don't try to go to the line, right? You just stay a little with some safety here. And you have the quote that this is Warren quote. So this is the final part of my presentation. The same conclusion as Georg, value beats growth. So this is a famous chart, again, the same, but not updated up to 2020. Clearly, value beats growth since the Second World War. But then I said, okay, let's check it a little bit. And I went to the indices from MSCI World to check a little bit more this performance. So normally, global equities long-term should perform at nominal GDP, let's say 6-7%. This is what we said forever. I checked with the MSCI World, and the performance in '69, so you cannot go much longer, it has been 8%, so we are not very wrong with this nominal GDP growth. But then you have two clear trends, 74 to 2000, 25 years of value, and 2001, 24, 23 years of growth. With the main difference is that the growth has been basically in the last decade. Growth has really done very, very well in the last 7-8 years. So my question is, are we going to have another value cycle for 25 years? We think yes. I mean, there's a lot of indications that suggest this. It correlates with a cycle, with an upturn, correlates with higher inflation and rates, correlates with the commodity cycle, with the capex cycle. So, you know, there's a bunch of signals that tell you that this can happen. The Magnificent Seven, so basically tech and these big guys that are doing fantastic, they are already 25% of the SPX, of the US index, and 70% of developed markets is US, which means that, you know, they are so big that, you know, at some point you cannot grow 10% forever to justify these valuations. So the options are starting to be much more favoring value than growth. I'm not saying that all the business models are wrong. The business model of Tesla will be questioned, in my opinion, but the rest have good business models. And something important for us is that in the end, value and growth, there's a lot of overlap. So it's not really only value, only growth. If you look to the right stock and you pick the right stock, you don't really care that much about that. But value will help us because we are value investors. So basically, for us, nothing changes. We will keep investing in good businesses at the right price, in a value, growth cycle, or whatever. And just a little bit on performance, since we did the MBO in 2019, as Alex was stating, we bought the company from Carlos, although Carlos is still there. We've done 12% per year, very happy, below some of our competitors here, but we are very happy. Our target is 10%. And again, let's highlight the power of compounding. 10% per year is doubling your money every 7 years and multiplying by 4 every 14. So this is the really only way to make up for your pensions or for our pensions or our kid pensions, because there's no other way really to make a 10% per year. So, you know, we've done 12, we are very happy. We think that this 12 is because we are learning, and as Charlie is suggesting here, people who learn and who focus in the long term, they will do rise in life, and we expect to rise with this statement. And in the end, value cycle is coming in our view, and commodity cycle is also coming, and we think we will benefit from that. And final slide from me before welcoming Grifols. This is our offer, a little bit of advertising. So you will recognize the sentence, our preferred attitude is partnership. So this is pure Warren Buffett. Investment philosophy, strategic value. Size, we will not grow that much. We don't plan to grow that much. We would like to be a bit bigger, but not too much, not to be institutionalized. Experience, we have a lot of experience. Risk management, we learned the hard way in 08, as I said. Track record, 10%, that's our commitment. With a risk-adjusted strategy, long-term, obviously. And we try to share with you and with all investors and companies what we do whenever we are requested. So, you know, the partnership is very important in our opinion. When we invest in a company, we are looking for partners, and when somebody is investing through us, we're also looking for partners. So that was my contribution. I tried to share a little bit my experience in 22 years, and now I welcome to Grifols, that is one of the tough investment cases we are going through.
Good morning, everyone, and thank you very much for having us today. Thank you, Marcos, thank you, Alex, and thank you, the whole team, for having us and for hosting us last night. My name is Danny Sagara. I'm Vice President of Investor Relations at Grifols, and I'm joined today with Eva Vidal, who is our Investor Relations Senior Manager. Today we will be sharing an overview of Grifols, our journey over the past years, and our plan and opportunities ahead to continue to drive value for our shareholders. We will be more than happy at the very end of this session, to take, your questions. Before that, but not at the end, I would like to bring your attention, to a forward-looking statement disclaimer. Okay. Grifols is a recognized leader in biopharmaceuticals, specifically plasma-derived medicines and transfusion medicine. This is more the diagnostic part of our business. Our therapies treat rare, chronic, severe, and life-threatening conditions, many of which are hereditary. We have three, as you can see, business units: biopharma, diagnostic, the transfusion medicine that I was mentioning, and biosupplies. Our biopharma unit consists of plasma procurement, production, and commercialization of plasma-derived therapies. Certainly, it's our largest business unit and a key growth driver, representing pretty much 85% of our revenues and probably a little bit more in terms of profit. Our diagnostic unit provides leading-edge diagnostic solutions for blood and plasma screening and makes up about 10% of our revenues. Our biosupplies unit offers high-quality biological products for non-therapeutic use. Grifols, as you can see in the slide as well, is a top player in a consolidated high-growth plasma industry. This market currently stands at close of 30 billion euros, and we have a market share of 20%, similar to the other two peers in the industry, the leading peers, which is CSL and Takeda. Over the last year, this market has grown at a mid to high single-digit rate and is expected to continue to do so. As one of our competitive advantage, we are vertically integrated, meaning that we are in control of all the steps that go from the donor donating its plasma to the patient receiving its therapies. We collect plasma in our more than 390 centers worldwide. We manufacture it, and then we deliver the resulting plasma-derived therapies to our patients, serving more than 100 countries across the globe. We also have a robust pipeline, including more than 20 assets, to treat conditions in those therapeutic areas, on those 6 therapeutic areas that we have our expertise. As maybe you are aware, the company is led by an experienced senior management team, which has recently been reinforced with the addition of Nacho Avia, a former Olympus executive, as a CIO, and other appointments in key positions, and supported by more than 24,000 employees. Now I would like to focus on biopharma, which is the leading business unit of the company. There is a large unmet medical need for plasma proteins worldwide. And Grifols, we play a really important role in providing these essential medicines. As you can see in the slide, key proteins are immunoglobulins, albumin, and alpha-1. For all of them, which we continue to see a positive demand and continued growth. Overall, no question, US still is the main market by far. But we continue to see an increasing growth ex-US, especially Europe, but also in China with albumin. Immunoglobulins represents the largest market, currently making up close to 20 billion euros, if we have a global share of 20%. We see this protein as the main driver of growth, especially considering the expected growth of some of its key indications, such as primary and secondary immunodeficiencies. And also, this is a little bit more technical, but also the remarkable opportunity that the subcutaneous IG, the subcutaneous immunoglobulin formulation offers. Albumin. Albumin is used primarily within hospital settings during surgery and intensive care, but also as a treatment for liver cirrhosis. With a market of more than 6 billion euros, we have close, again, 20% share, with a leading position in China, which is the main market for this protein by far. Finally, our alpha-1 protein treats chronic genetic disorder, but we have a close to 70%, so a really leading position, 70% of market share. And we are really seeing positive momentum in key markets, especially US, but also Europe, for alpha-1 as under diagnosis stands at 90%, which the opportunity, that's why it's so significant. So overall, our portfolio has positioned us to continue to build momentum and deliver further growth. I'm going to go quite quickly on this one, trying to save some time here. We have a strong global footprint, and we have strengthened and diversified our presence over the past few years. As mentioned, we have fully integrated the journey from donors to patients into our operations, with more than 390 plasma centers globally, as I was saying, but also 6 manufacturing plants spread across US, Europe, Egypt, Canada, and China. We have 13 R&D centers, pretty much located in 4 hubs, 2 in the US, North Carolina, California, Europe, in Germany, but also in Spain, and China through Shanghai RAS. We will talk about Shanghai RAS a little bit later. Okay, that's the most important. I think that the next 2 slides are the most important one together with the last one. So what happened in this company over the last years? It was kind of like the perfect storm. The COVID-19 was a difficult time for the entire plasma industry, including the company, including Grifols. We were faced with the initial outbreak in Q1 2020. The government lockdown and financial stimulus programs, especially in the US, prevented donors from donating plasma. Actually, our plasma supply dropped by 20% in 2020 and 2021. And the challenge number 2 is that we got a significant increase in the cost per liter of plasma. It increased in the range of 30 to 40%, peaking in July 2020. Which means a huge increase in a really short period of time. Certainly, it had a direct impact on our EBITDA. As I said, we were right in the middle of the perfect storm. But there is some hope here, right? In 2022, we were well on the road to recovery from the main impacts of COVID-19. Starting mid-2020, plasma collections started to rebound significantly, and as a result of this, we saw plasma supply increase of 20% only in 2022. I agree that the baseline was low, but an additional 10% in 2023. Q1 24, an additional 8%, if I'm not wrong. So certainly, as you can see in the graph, today we are collecting on a weekly basis more than what we were doing back in 2018. Regarding costs, we implemented an aggressive operational improvement plan that is yielding more than 450 million euros in annual cash cost savings. 450. Most of these savings, no question, were on the plasma area, including a reduction of donor compensation, donor center rationalization, but also process efficiencies. As a result, Q1 2024, cost per liter had declined more than 20%, roughly 25%, compared to July 22, which was the peak. Today, having left behind all these impacts, plasma collection have increased significantly and cost per liter continues to drop. So we certainly believe that the company is on track to further expand its profitability. And I cannot wrap up, my part, without bringing some additional numbers here. As you can see on this slide, the financial performance turnaround story is clearly reflected in 2023 within 3 fronts: revenue, EBITDA, but also our leverage ratio. We delivered 6.6 billion euros in 2023, which was an 11% growth at constant currency versus the prior year. And as said, mainly driven by the strength of our biopharma business unit. As you can see in 2024, our guidance, we expect, and we are on track of it, to deliver more than 7 billion in revenues, which means more than 7% growth at constant currency, driven by biopharma, which is expected to grow in the 8 to 10% range. Our adjusted EBITDA reached 1.4 billion in 2023 at a margin of 22.4%. As said, driven by continued revenue growth, cost per liter reduction, increased efficiency, and operational leverage. We are confident, we remain confident in our ability to continue to expand our margins, and we are expecting our adjusted EBITDA to exceed 1.8 billion in 2024, alongside a 25 to 26% margin for the year. So again, as you can see, I would like to highlight, that as you can see in the graph, the margin expansion is quite remarkable here. Finally, we got to say that we remain focused on reducing our leverage ratio, and a testament of this track is that we are able to reduce it organically to 6.3 times in 2023. It's true that it is compared to 9 times, which is quite high, that we reported right after the acquisition of Biotest, which was a kind of like a transformational acquisition for the company, but it's true that it took place in the first half of 2022, and as you can see in the graph, the EBITDA at that point was quite impacted by all the impacts that I was mentioning related to the COVID-19. We are targeting 4.5 times by the end of 2024, driven by 3 levers. The proceeds from the 1.6 billion euros with the sale of the 20% of Shanghai RAAS, our stake that we have in China, which will be closed this month, June 2024. Organic EBITDA improvement, as you can see in the graph as well, but also cash flow improvement throughout the year. So thank you so much for listening to me, and I will now pass you over to my colleague, Eva.
Hello, thank you. I'm going to try to be very, very executive as I'm very conscious of time. Thank you very much for having us here today. I'd like to cover a little bit the future. So we've seen that Grifols has faced many challenges and overcome them, but now I'd like to focus on what's ahead. The company is facing a new chapter of profitable growth. So as we look into 2024, the plasma industry continues to be very strong. The trends continue to be very favorable. So in terms of collections, they are expected to continue to favorably grow sustainably. Cost per liter is expected to stabilize going forward too, on top of some efficiencies and increasing yields that we are expecting also to achieve. This also leads us to say that the company is very confident on achieving the guidance that Danny has covered briefly previously. So we are expecting to achieve that also for 2024 in order to continue growing and expanding our margins. Aside of that, the company has 2 main top priorities. First one is debt reduction. So on the one side, the company has announced recently the private placement notes amounting to 1.3, which will clear the way until 2027, as the company is now committed to tackling its 2025 maturities. And another evidence of that is the Shanghai RAAS deal, which is expected to close this month, and it will provide us with 1.6 billion euros that will certainly contribute to reduce our debt. Also, another priority is cash flow. We are very conscious on improving our cash flow, and the company currently has a plan in place in order to enhance cash flow on 2024 as well as on the years beyond that. Another important area to mention is governance and leadership. As Danny has mentioned, the company has a new CEO, Nacho Avia, who will certainly be an important person in this new next chapter of growth. So also another important thing is that the company has separated ownership from management, as well as the roles of executive chairman and CEO. In terms of leadership, the company has reshuffled its key management positions, such as innovation, biopharma, or digital. And I'd like to cover also briefly the commercial expansion and innovation piece. The company is focused on unlocking further opportunities from its key proteins, such as immunoglobulins or alpha-1, as well as continue to accelerate its pipeline. And I'd like to highlight 2 key proteins that will be launched in the market soon, which are fibrinogen and trimodulin, which will certainly contribute significantly to our margin expansion. And last but not least, simplification is key. The company is really focused on simplifying its processes and structures in order to be more cost-effective, leaner, and more streamlined. So all in all, we think that the company is very well positioned to increase further value for its shareholders. And linked to that, I wanted to end the presentation with a very important slide to us, in which I would like to convey a message which I think is really clearly represented in these 2 graphs that I think they talk by themselves. So the company trades at a really significant discount, as you can see on this graph, both comparing the EBITDA multiple to historical performance, as well as to other peers in the industry and in the biotech and the pharma industries. So this discount is hard to explain by itself. We think that it offers a significant opportunity. And I'd like to end by saying that the company has changed. We are operating in a very high growth industry. We have strong fundamentals. We are one of the 3 main players in the industry with very high barriers of entry. We've changed our management, our governance. We have really commercial, a really good commercial portfolio, a really robust pipeline, and we are really very well positioned for this new chapter of profitable growth. So thank you very much. I hope I've been quicker enough. Thank you.
Because we got out of time, so I will ask only one question, if I may. So this question is, because we talked about leverage, you showed the 4.5 times leverage this year, but there's, is there a risk with the sale of Shanghai RAAS? This would be a quick question. Is there a risk not getting this 1.6 billion that everybody expects? And the second question would be, what do you think about the research of Gotham after 6 months dealing with the short selling story, with all the investors, with the share price down 40%?
Okay. The recommendation is that you cannot say yes or no to any question, but I'm going to make an exception to myself, and the answer to the first question is yes. China will be done this month. We don't have any major concern. I mean, it should be something such unexpected that we are not even considering. On the Gotham one, I mean, I don't think that the Gotham thing is going to make any change per se, but probably it's going to accelerate some changes that were already approved. The fact that we have a new CEO, since April 1st, it has not been because of Gotham. I mean, it will not make any sense, to think that in like 2 months we can hire, such a exceptional executive like Nacho in 2 months. So the roadmap was set in 2023. All the main decisions, including the separation of ownership and management of the company, was already taken. Some sort of acceleration because of Gotham, I cannot say no.
Okay, thank you.